Welcome to the Knakal News Network. The Knakal News Network is brought to you by the Knakal Group, Cushman & Wakefield's #1 investment sales team.
Hi, I'm John Hageman, Executive Managing Director at Cushman & Wakefield. Welcome to the Knakal News Network. Today we're here with Bob Knakal, Chairman of New York Investment Sales, and we're going to talk about the Manhattan 2016 sales market. So Bob, last week we talked about the overall market throughout New York City and the results of the 2016 investment sales market. Today we want to dive into Manhattan specifically, but for those viewers that didn't get a chance to see last week's episode, maybe just give us a brief overview of the overall market.
Hags, that's a good idea. In 2016, citywide, the dollar volume of sales was down about 25% from 2015. We were at about $58 billion. And the number of properties sold was down 16%. Interestingly, the values in the city were up about 9% last year, hitting an all-time record of $534 per square foot. So volumes were down, but values were up.
One of the things you also mentioned last week was what happens in Manhattan, trends in the market typically happen in Manhattan first. What happened in Manhattan specifically?
The dollar volume of sales in Manhattan was down 34%. Versus the 25 citywide. The number of properties sold in Manhattan last year was down 30% versus the 16% citywide. So from a volume perspective, things slowed in Manhattan much more significantly than they did in the outer boroughs.
So that's again volume and properties sold. What about value?
Interestingly, value went up 9% citywide. But in Manhattan, values hit a new all-time record, $1,450 per square foot, which was also up 9% over the 2015 level on a price per square foot basis.
So why do you think that's the case, Bob?
It doesn't make any sense, and I think it's the case because we're looking at the year as a whole. You know, if you look at market conditions, we saw degrading market fundamentals in rents. In all three food groups, residential rents were down, had been falling for now about 10, 11 months. We've seen retail rents drop significantly, and so there's downward pressure on retail rents. In the office sector, we've seen concession packages grow significantly. That normally is a precursor to having rents fall. So we have rents falling, interest rates have been rising, so lending rates are up, so cap rates are up. And if you have falling rents and rising cap rates, that has to lead to a reduction in value. So I asked our research department, which, as you know, the top research department in the city, I believe, I said, guys, this makes absolutely no sense. Let's look into these numbers. Values can't be up based on this set of market circumstances. So what we did is we looked at the number of properties sold last year. We had 765 properties sell in the Manhattan market. And of those 765 properties, 2 of them were really outliers. There were 2 retail condominiums that sold on Spring Street, one at $17,000 a foot, and one was at about $26,000 a square foot. If we simply remove those 2 sales from the data, the appreciation rate goes from plus 9% to minus 1%. So effectively, it was flat without those 2 sales.
So wait, Bob, flat is not so bad. Shouldn't there still have been a bigger reduction than that?
Well, that's exactly what we thought. We thought if it's down 1%, that's effectively flat. So we started looking at transaction by transaction, and we said, you know, maybe the marketplace shifted over the year. What was the first half statistics versus the second half statistics? And interestingly, if we look at those comparisons, we see that in the first half of 2016, the average price per square foot was $1,617, where in the second half of the year, the average was $1,263. So over the course of that period, it was a 22% reduction in value. That was more indicative of how we felt market conditions actually were performing. But then we looked at the numbers on a quarter-over-quarter basis, and we see a significant reduction in value, where in our first quarter of the year we had an average of $1,754 per square foot. And by the fourth quarter of 2016, that average was less than $1,100 per square foot. So that really is a much more indicative picture of what market dynamics were. Certainly explains what happens in a market when you have downward pressure on fundamentals, increased upward pressure on interest rates, and that's really indicative of what's been happening in Manhattan.
With that being said, what is something that you think could help turn the market around?
As you know, over the past 34 years, 3 of the top 4 years in terms of the number of properties sold has occurred in years in which there have been tax policy changes, 1986, 1998, 2012. And so to the extent that we get some kind of relief on tax rates, particularly in the capital gains rate, that could lead to a significant amount of selling. And that would be a great thing for the marketplace. In summary, in 2016, the Manhattan marketplace took its lumps relative to the outer boroughs. The dollar volume of sales was down 34%, and the number of properties sold was down 30% from the prior year. Values, while being up on an annual basis, showed steady declines throughout the year on a quarterly basis. It will be interesting to see how values perform as we get further through 2017.
Thank you for joining us today. Tune in next week for another episode of the Knakal News Network.